If you're an accounting student and you are still confused on how the double entry system works, then this video is definitely for you. Okay, now let's see how we can understand the double entry principle and then how the ledger account, okay, how the ledger account works or how we post in the ledger account. Okay, now I'm starting with the double entry system because I think the ledger account is hinged on this principle. Yes, the ledger account obeys the principle of the double entry system. Now, for you to be able to do perfect posting, or let me say correct posting in the correct account, you need to, you want to know, if you want to know when to post, how to post to each account, and where to post, because like every account has debit and credit side, right? So you are still confused on where to post, when to know when to post on the credit side, when to debit an account like that, then this video is definitely for you. Okay, now before I start, first of all, I want to introduce 5 classes of account. Okay, I said 5 classes of account. So we have assets, we have liabilities, we have capital, we have expenditures, and we have revenue. Okay, so I'll be writing that quickly. All right, so these are the 5 classes of account that we have. So it means that every other account, somehow fall under one of these classes. Okay, so we have asset, like I said, liabilities, capital, income, and then we have expenditures. So these are the 5 classes of account. Now you need to know that in the accounting cycle, the double entry system means that every transaction is going to affect 2 accounts. I think that's the simplest explanation. So we have to record twice. That's why it's called double entry. We have to record twice. So the system that has to do with recording twice in the book of account, okay, is what we call the double entry system. It means that they believe is that every transaction in a business will affect 2 accounts, okay, and one of those accounts will be credited and the other account will be debited. You know that every account has a debit and credit side. I think that's one thing an accounting student should know, okay, that every account has a debit side and then a credit side. Okay, so how do you know which account to credit and then which account to debit? So that's what this video is all about today. Now let's start with the asset account. So the asset is literally what belongs to the business. Now before I start this, I have to introduce one of the concept we have business entity concept. Okay, it's an accounting concept that believe that the business is separate from the owner. Okay, the business is separate from, that's the belief of the accounting world. It's a concept. So the business is separate from its owners. Okay, so whatever the owner puts into the business becomes the business own, and that's the reason why we have terms like capital. Okay, whatever the owner gives to the business is what we see as capital. Now let's start with the asset. Okay, now the asset, like I said, whatever belongs to the business is the asset of the business. So if the cash, the money that belongs to the business is the cash for the business, the money in the business bank account is the asset of the business. If the business has a car, we use car, maybe they have a delivery van or motor vehicles for other activities, business activities. Okay, furniture fitting. If the business has a land, if the business has a premises, all in the business name, of course they are all the properties of the business and they are separate from the owners. Okay, they are separate from the properties of the owners. All right, so everything that belongs to the business is what we refer to as assets. Now asset can be long term, that's non-current asset, and then we have current asset. Non-current asset means that this asset can last for more than a year, or they can still be used even after a year. Okay, I think accounting, another concept to have is periodicity concept. Okay, that means we should be able to measure the value of a business in a year, in a defined period, usually a year, that's 12 months. Okay, now so whatever that belongs to the business are the asset of the business. Now the next things are liabilities. When we talk about liabilities, liabilities are like claim of outsiders on the business. That is simply to say what the business is owing outsiders. Then whatever the business owes to that person is what we refer to as liability. So when they buy goods on credit, the amount of that, the value of the goods that were sold on credit is a liability. And then maybe if a business collected loan from an outsider, okay, we can still call it a liability. Okay, so whatever the business owes, the claim of an outsider on the business, that's whatever the business owes an outsider, is referred to as what? Liabilities. Now the next one is capital. Capital, now let me say whatever the owner of the business, okay, whatever the owner or owners of the business deposit or invest in the business is what we refer to as capital. So if the owner introduces his car for business purpose, that if he's sacrificing his personal car for business purpose, then the value of that car becomes capital. Okay, the value of the car now becomes capital. So whatever that the owner of the business introduces into the business is what we refer to as what? Capital. Okay. Now, capital, liability, and asset. Now we have an accounting equation. Like I said, I want us to understand double entry, but I'll need to start from the basic things. Okay. Now we have an accounting equation that everything that the business has either comes from what the owner introduced into the business or what the business is owing to outsider. So all that the business has is either the owner brought it or it was a loan or on credit from outside. That's just a simple explanation. Are we together? Now, the next one is income. Now, income has to do with money coming into the business as a result of business activities. Any money that the business is able to generate as a result of its activities. Okay. Now, something like sales, we have commission received, we have dividend received. That's where the business invests in other businesses. Okay, we have dividend received, we have commission received, we have sales. Sales is the primary source of revenue for any trading business. Okay, for any manufacturing or trading business. So sales is their primary source of income. Okay. Now then we have expenditures. Every other activity that makes money go out. Okay. Whatever that makes money go out, whatever that makes you to spend. For example, you have to pay salary, you have to buy goods, you have to pay transportation, you have carriage inwards, there are a lot of expenses, you have to pay for utilities. Okay. Now at the end of it all, we should have a balanced account. That's what we should be able to reflect that the amount we had previously and then the amount that has gone out and the amount that has come in. So all this put together, I'm going to be giving an expanded equation. Okay, that assets plus expenditure, so capital plus liabilities plus revenue, that's income. Are we together? Now with this is how the double entry system works. Simple. Now assets and expenditures are debit items. Okay, they are debit item. That means if there's an increase in asset, we are going to be debiting asset account. Okay, so by nature, asset and expenses are going to be their debit items. So it means as assets increase or as expenses increase, they're going to be debiting the respective account. Okay. Now on the other hand, capital, liability, and revenue are credit items. So that means that as capital increases, that is, if the owner of the business introduces more amount into the business or more resources into the business, or the liability, that is claims of outsiders or revenue. Okay, as these things increases, you're going to be crediting the respective account as well. So at the end of it all, there should be a balance between the debit side and then the credit side because of this expanded equation.